analysis, which is the primary method that I use. What we're looking at is the S&P 500 on a 1 month basis, and we're doing the Elliott Wave count. So 2000 top was the end of a very large third wave. Then we have an A, B, C wave in 2008 to 9, which ended a secular bear market, which was the fourth wave in that larger five-wave pattern. Since 2009, we've been in a secular bull market. We have this back and forth, back and forth, back and forth, explosion higher into 2014, 15. This is clearly third wave behavior right here. We have a correction in 2016, blow off top into 2018, which ends the third wave. This has been the count I've been working with for years. Then 2019 to the COVID low was your fourth wave. And where we've been since has been this kind of exaggerated fifth wave blow off move since the COVID low. There's two ways to count this from the way I look at it. One is that the February 2025 low or high was it. That was your fifth wave. And so we have an A and a B wave that we're in, which would be followed by a pretty aggressive five-wave drop. I know that seems impossible right now, but just pointing out what the price data is pointing to. The other scenario is that instead of the 2018 top being the end of the third wave, the 2021 top would be the end of the third wave, to the 2024 low being the fourth wave. Now, people have said that this is seemingly a bigger correction than what happened in 2018 to the COVID low, and it's just not. You can see how complicated and drawn out this pattern is, and how deep that it went. So 2022 was minor compared to what happened from the 2018 top to the COVID low. But anyway, it could still be counted as this larger fourth wave. And what that would mean is that we're in this ending diagonal for the final fifth wave. That'd be 1, 2, 3, 4 into April, and we're in this final fifth wave move right here. Now, it's worth noting how divergences have just been building and building and building and building. Where the S&P is on a monthly chart is probably the most dangerous spot in terms of these momentum indicators, this composite index. You see how not only are we diverging as price is going higher, but it's finding resistance as these moving averages are going negative right as they're crossing. That's usually the most dangerous spot. You can see it right here. It happened right around that wasn't really. You usually see it on these kind of B wave moves. Let's see if I can find one. Yeah, there's one right there. They're not perfect, but whenever I see it, you can see right there. So moving averages crossing over here in 1994, as the composite index was using it as resistance, and what followed was that bigger drop right there. So doesn't happen every time, but whenever I see that pattern, I get cautious. So that's where the big picture is pointing to. Okay, moving over to the kind of intermediate time frame, which is the 4-day chart that I use. This is the S&P 500. So I've said we're in this ending diagonal, and I've gone over almost every meeting. I'll go over it again, but the red count, which says that the top was February 2025, has this being the first wave, this being the second wave into the March 2023 low, July top into 2023. The fourth wave is the October low into 2023, and we have a blow-off fifth wave move that ended in February. And then we have our A into April, a B wave that has slightly gone above the top of the top of the A, and what would follow would be a pretty aggressive five-wave move. These are my targets for the price pattern. One characteristic of diagonals, ending diagonals specifically, is when they end, historically we tend to, and this is pretty consistent, very high probability. Almost every time I see this, an ending diagonal end, we see this happen. We tend to retrace relatively quickly the entirety of the ending diagonal. That's the October 2022 low. So this is, takes like 3 years to play out, 2+ years to play out. So relatively quickly would be like a 6-month period, 6 to 9 months, something along those lines, maybe something around there. I've never seen any diagonal on this degree before. We usually deal with them on smaller degrees, but this is clearly what's playing out. The other scenario is that instead of this being one, two, three, this whole pattern from the 2022 low to the July 2023 top was your first wave. There's your second wave. That was the third wave in February of 2025. We had a fourth wave into the April low. And what needs to happen is A, B, C. So this pullback needs to, instead of being a five-wave drop, which is what C waves are, needs to be a three-wave drop that holds, I would say around 53.45-ish is like my absolute max that I would give it. And then we get a final blow off. Now, we did technically make a new high. So you could think to yourself, well, could that be the fifth wave? And I would say no. And the reason is the proportions. Look at how long the first wave move is right there. I mean, the first wave move was many, many months. And this just isn't really, doesn't really line up with the proportions of what this pattern would say. So we would need a B wave and then a final C wave. And we would can get pretty exact targets once we get that confirmation of B wave and a low, and then we turn higher. So that's what we're looking at. Now, when it comes to the internals, historically, the RSI, which tends to be used, I think, incorrectly as an overbought signal and oversold. I almost never use it for that. What it's better for is all this information in the middle. There's usually a bear market resistance level and a bull market support. In other words, in bull markets, we'll tend to bounce off these, we won't go below this green line, so to say, in bull markets. However, in bear markets, we will go below that line, which we did. We technically did. Where it gets interesting is whenever we start making new highs after breaking above it, you see, right here in March of 2024, broke above it again. Then we start kind of topping below it. And the March 2025, actually the 2025 high made kind of like a double top, but we topped just at it. And when was that? December of 2024 before turning lower. So we're not even really testing it yet. We're still kind of in this bear market correction. We usually see in bear markets, it kind of goes in this red range right here. We're just above it. We're kind of on the upper boundaries, but we're not, we still have room to go. But what I find interesting is that we're getting a divergence in the composite index. So lower high versus the RSI making a higher high. This is what you call a hidden divergence. The composite index was designed, was created by Constance Brown to basically solve the biggest problem in the RSI, which was that big turning points, it doesn't give you divergences. So it's basically the RSI with a momentum filter built into it. And you can see these hidden divergences all over the place. Like right here, see how RSI made a higher high into the July high, but the composite made a lower high. And so that's a hidden divergence. And it happens all the time on highs and lows. So anyway, here going into the 2020 top, the composite index was showing a significantly weakening momentum to where the RSI really wasn't. So anyway, that's the point of it. We have a hidden divergence, usually not good, and the RSI is still below the bear market resistance. So, and this is all happening on volume decelerating as price goes higher. The kind of patterns you see when you're getting closer to like some kind of a turning point. If we zoom in a little bit closer, here's the S&P 500 1 hour chart, and we're just basically analyzing the bounce. It's clearly a three-wave move. Off the low, one, two, three, there's A, one, two, three, there's B. And then we get this kind of vertical move higher, which is a five-wave move, which is very characteristic of C waves. This one is extending pretty long in time and price compared to the length of the A and the B, but still, just to kind of show you what we have. Um, there's one, there's two, there's your kind of third wave gap right there. There's four, and this is clearly a diagonal. It's an ending diagonal. Look at how overlapping this pattern is. It's tracing within this kind of trend line. We're getting this double top right at the kind of upper boundaries of this trend line. So it's either the ending diagonal of the entire pattern, or it's the ending diagonal of a third wave. Instead of this being three, this is three. And what we'll see is we need to see a break below 61.78 that will signal that there's some kind of a top in place. And the blue count saying that this is the third wave would hold over 59.20. and then we turn back higher for one more high, probably into that, late July, early August time factor, August 2nd time factor. Um, so that would be that scenario. The other scenario is break below 61.78, break below 59.20, and then we have this bounces over. And then we go to our original plan, which is, are we in a five-wave drop or a three-wave drop? And the levels to monitor, they haven't changed, are 57.68, 56.45, 55.15, then 53.45 is the final support that I would give this. When you start looking at Bitcoin's long-term cycles, let's see here. Right here, this is a monthly chart. There's this cluster coming up right here in July, which we're approaching it, right? So let's say we push up into this cluster and start making new highs on lower volume and lower momentum. I'm sorry, that's not good. You'll probably see us start taking some gains, more gains. However, if we get this move right here, you see how it's kind of this overlapping mess. I would say this is an A, this is a B, and then we get a five-wave move down to like 91, maybe like 87 into that July time factor. In other words, this would be setting up for a second wave right there. Then we're in business. That's good. That's bullish. We'd be buying that and we'd be upping our targets. That target would be around like the 180s to 200s. Okay. So we'll have to see one step at a time. We know what matters. This time frame is going to matter a lot. July. Are we trending up into it or down into it is going to be the big question. And the setup will allow for both right now. Moving on to coin. So this is the big picture in coin. It's a diagonal. See 1, 2, 3. That's one. There's your second wave. I have A, B, C for the third wave right there. And then that was 4. We just finished 4. And look, it's pretty clearly a three-wave move. 1, 2, and vertical 3 right there. So the question is, and this lines up with Bitcoin, are we doing it? Are we almost there? Are we going to see like maybe a move up to like 400 and then it's over? I said last week that Coinbase was going to be the tell because it hadn't made a new high. Well, it just made a new high, so it's not going to be. It's right in line with Bitcoin. The next move lower, whether it's going to be a minor correction before a bigger blow off, is going to be 3 waves, or if this is the top, the next move is going to be 3 waves. So it's not going to be very clear until we start kind of getting some bounces. However, this is the big question. And I think Bitcoin is going to be the determining factor as of right now. Is Bitcoin going to break out with Coinbase and move higher the next few days? Or are we going to see something like this where this is a larger A wave in green, we get a B wave back into this zone, and then we get a big blow off move up to like the 650s or something like that? That would be fantastic. And that would line up with Bitcoin going up to like the 200s. Okay, so we'll find out. We're going to find out pretty soon.